Hello and welcome back to Option Bank, your premier options trading platform. In the last video on bonds, we looked at the basics of bonds, and some of their characteristics including concepts of face value, coupon and coupon rate, maturity, different types of issuers and yields. All of these characteristics play a role in a bond's price. Understanding the most widely traded government bonds, and the price fluctuation in these bonds are two targets we aim to achieve in this video. First, we will walk you through the most actively traded bonds in the bond market. US government bonds are the most popularly traded bonds in the world. There are four types of debt issued by the US Department of the Treasury to finance the government's spending activities. They are Treasury bills, Treasury notes, Treasury bonds and Treasury inflation-protected securities. Backed by the US government, which has various means to ensure full repayment, these investments are virtually considered to be risk-free. These securities vary by maturity, denomination and coupon payments. So let's begin with Treasury inflation-protected securities. Treasury inflation-protected securities refer to a Treasury security whose par value increases with inflation and decreases with deflation, as measured by the Consumer Price Index. TIPS are available with 5, 10, and 30-year maturities with a minimum investment of $100. Interest on TIPS is paid every 6 months, at a fixed rate. The next is Treasury bills. A Treasury bill is a short-term debt instrument with a maturity of less than 1 year, sold in denominations of $1,000. Investors do not receive regular payments as with a coupon bond, but a T-bill pays an interest. Now we move to Treasury notes. A Treasury note is a debt instrument with a fixed interest rate and a maturity between 1 and 10 years. The 10-year T-note is the most widely traded. Interest payments on the notes are made every 6 months until maturity. The only difference between a Treasury note and bond is the length of maturity. Treasury bonds are issued with maturities that can range from 10 to 30 years. Like Treasury notes, T-bonds are issued with a minimum denomination of $1,000, and coupon payments are paid semi-annually. Other countries also issue debt securities that are the equivalent of US Treasury securities. These include Japanese government bonds, gilts, issued by the British government, and Schatzen bonds issued by the Federal Treasury of Germany. After initially selling through an auction, bonds are traded in the secondary market where their prices fluctuate continuously. So why and how does this happen? Each bond has a par value, and it can either trade at par, at a premium or at a discount. Par means that a bond with a principal amount of 1,000 units payable at maturity is also selling at a price of 1,000. If the bond's price is higher than its par value, it is selling at a premium. In case the bond's price is lower than its par value, the bond is selling at a discount. It is important for bond traders to know how to determine the price of a bond, because it will indicate the return received should the bond be purchased. Interest rates and bond prices have an inverse relationship. If interest rates fall, the price of bonds trading in the marketplace generally rises, and vice versa. For example, a bond with a face value of $1,000 and a 10% coupon rate pays $100 in interest a year, even if its price changes. If the bond's price is $1,000 at par, the coupon payment is equal to the yield, which is 10% in this case. If market prices change and the bond's value falls to $800, its yield climbs to 12.5%, or $100 divided by $800. If the bond's price climbs to $1,250, the yield will decrease to 8%. That's $100 divided by $1,250. 3 other factors that influence a bond's current market price are the credit rating of the entity that issues the bond, the market demand for the bond and the time remaining until the bond's maturity date. Credit ratings of bond issuers are assigned by credit rating agencies. In general, the higher the credit rating, the higher are the bond prices as the investment is deemed secure. If the rating goes down, it will drive their bond prices lower. The maturity date is an important factor because as the bond nears its maturity date, the bond price naturally tends to move closer to par value. Thank you for watching.